All right, everybody, welcome to the webinar. This is Victor Medina. We're going to get started in just a couple of minutes. Here it is at 5 o'clock. Hopefully everyone has joined us here. If you're here, let me know that you're here. Drop a comment into the comment box. I will get to see that and let the other folks know that you're here as well. This seminar is retiring in a recession. And so hopefully you're here for the right topic and the right reason. We're going to be covering everything that we think you ought to know around that. So again, we're starting to see some of the numbers coming in. Hopefully other people will join in as well. Got a few people online. And just again, let me know that you are here by dropping a comment in the comment box and I will get to see that. I wanted to give you a little bit of information for what it's going to take for us to get through here today. And so I'm not going to be taking more than about 35 to 40 minutes of your time. So hopefully that's how much you have budgeted. If you have questions along the way, putting them into the comment box is the best way to let me see them. I'm open to having questions, open to answering them along the way. So anything that you want to drop in there, go ahead and do that. Seeing the numbers starting to come up, so we've got a few in here. Good to see you, Mark. Welcome. Welcome to the event. And for those of you that were previously scheduled to come over to our on our office and do the dinner, I'm glad that we switched this one to online because it's actually kind of drizzling out here right now. So we broke down the tent and the tables from last night's event, and it's a good thing that we didn't try to hold it tonight anyway because it would have been pouring on top of us, and that would have been really super uncomfortable and not good for the electronics either. So in any event, let's get started with the actual presentation today. I have to go through a couple of slides for you to see. So this is sort of the beginning slide off of that. This is a disclaimer. So we're going to be talking about financial related matters. And so what I have to do is I've got to leave this up here for a little bit because I have to make sure that you know that anything that we're going to be talking about is not going to give you any guarantees on anything. We're not going to talk about performance on certain products. I'm not going to be selling any products here today. And we just want to make sure that you know all of that with the slide that we have in here. Okay, so getting on to the topic for today, those of you who are looking to figure out whether or not you want to explore doing retirement planning with us, we're going to give you an opportunity at the end of this to schedule an appointment to talk with us. That is going to be no cost and no obligation off of it. Probably the most valuable piece of information that I will give you is the opportunity to continue the conversation, and the best way to do that, especially in this post-COVID, post-pandemic world, is to go ahead and text the word retirement to 609-293-4344. If you know that's you already because you've done some research on us, you can start that process already, but I will put this up a couple of additional times. So where are we? How did we get here? Well, before I even go into that, I do want to talk a little bit about myself, and I want to talk a little bit about how my journey came about to be. So I have a very unusual set of background credentials. A lot of people are, I guess, financial advisors, and they hold themselves out to be that way. Primarily, I am an attorney. So I started my career doing estate planning for folks. And the journey for me to add financial services was actually driven by a client of mine who I like to call my sock lady. And the reason about that was she came to see me after she unfortunately had gotten widowed. Her husband passed away, and so she needed to do her estate planning. And one of the things that we pride ourselves in our practice is really giving people an opportunity to have a great experience all the way through. So we treat them like family. Everything that we do with them is really kind of focused on making sure that they're virtually hugged through this process. When you put an estate plan together and you're worried about what's going to be going on, it's like going to the dentist. Nobody really wants to do it. So we want to make sure that people have a great experience all the way through. And so I remember that I asked this client, we do it in the beginning of the engagement. We say, if anything ever goes wrong, let me know about it. I want to make sure you have a great experience. So I remember I did that with this client, and then I ended up checking in with her afterwards. And I said, well, how did it go? Did you enjoy everything that we did for you? She said, well, I'm angry at you. I said, you're angry at me? Why are you angry at me? I thought we did everything right. I was checking in with you all along the way. She said, well, no, you're leaving me. I'm angry with you because we've developed this great relationship, but I have all of these questions and I don't know how to get them answered. And so one of the questions that she had was, did she have enough money to buy socks? And the reason why she had this question is when she was married, before she'd gotten widowed, she would always ask her husband, do I have enough money to buy socks? And he would undoubtedly tell her no for a period of time. I said, well, listen, I don't know a lot about investments yet, but I do know that you have enough money to buy socks if you would like. I said, how patient are you? And she said, well, I'm a pretty patient person. I waited this long to buy socks. I said, okay, well, look, here's what we're going to do. I'm going to go out and get all of the credentials that are necessary to become a fantastic financial advisor and retirement planner. I'm going to go out and get a CFP. I'm going to go out and I'm going to get a retirement planning designation. I'm going to get a securities license. I'm going to do all that kind of stuff. And when I'm done with that, if you still like us and you still want to come back, maybe we can be your financial advisor. So it was my favorite sock lady that got us involved in making sure that we take clients all the way through the process. And so again, we've got this unique way of being able to do both estate planning and financial planning, specifically in the retirement world. And the way that that works well out for clients is that we're able to focus on being fiduciaries for them in every part of their world. We look out for their best interests. We do that as their lawyer, and we do that as their financial advisor, and it really gives us an opportunity to serve clients well. And I'm really excited about what it is that I do. Okay, so back to where we are and how did we get here. You're watching this largely because in everything that we have been doing when it comes down to this post-pandemic, the stock market has been reacting in crazy, crazy ways. And it has informed people in wild ways about what they should be doing or shouldn't be doing with their investments. When we start to think about the roller coaster of the stock market and everything that's involved there, it turns out that every day there was a piece of news, and people kind of reacting to that is what caused people to get worried that what they had or they didn't have was going to last along the way. So one of the things that we want to make sure that we talk about is we want to make sure that we talk about doing more than just wondering about what we should be doing. One of the things that we pride ourselves on is we pride ourselves on essentially being the place where you can get a plan put together. And that's an important component of the way that we focus on our advice giving. We don't make recommendations in and around products. We don't make recommendations in and around specific planning strategies. We do it in the totality of everything that people need to know, whether it's their income, their investments, their income tax planning, estate planning. It's all part of one thing. And so what I want to drive home as part of what we're doing here is that I don't want you walking away kind of wondering and trying to figure out what you should be doing. I want you focused on the idea that what you should be doing is planning. So let's figure out a little bit about kind of the financial component of how things have gotten here. If you were staring at statements along the way, you may have been shocked to see the values go a little crazy. If we're looking at the factors that are affecting retirement right now, these volatile markets, things kind of going up and down, and we'll talk a little bit about how quickly we ended up losing money and how quickly we ended up gaining it back, but also uncertain future. And we're going to put that in the category of a couple of different things. We're going to put it in the category of, not only uncertain futures about what the stock market might hold, but we also have uncertain futures about what are we going to see with an election, what are we going to see with tax policies, and all of those kind of jumbled together end up getting people feeling like, I'm not really sure what the future holds. Well, you got to focus on what you can control as opposed to the things that you can't control. And that kind of gets us to the last component of that too, which is retirement questions, those things that drive your specific planning. And so everyone's going to be a little bit unique, even though there are going to be factors that essentially kind of affect everybody at the same time, right? So what they do with their investments and how they do their tax planning, they're going to affect everybody, but what their goal is, specifically what goal they have, is really going to be determining what their individual plan looks like. So we talked about the volatile markets, and one of the things that we're focusing on is that, in fact, it turns out that this is probably, if you look at this chart talks about the speed of the market collapse. You can see at the very top here that the top 3 or 4 of these are centered on, first, the 22 trading days from February 19th essentially to March 9th, March 10th when the collapse of that first sort of set of returns off of that, March 9th when we lost about 30%. That's the fastest trading time to lose 30%. And then the next 3 times after that are all centered around the Great Depression. And so those were a series of those. And so that is one of those alarming things that happens. And so if we try to figure out what the importance of a market drop is, we need to use some real numbers to kind of understand the impact, because there's a lot of news that goes out there that says, well, this is the greatest increase in the market, or we've seen a market increase of 5%, 10% of whatever it is. If we lose 50% in a market decline on $1 million portfolio, there's $500,000 that's remaining. Now, some of you know this math already. But if we have a 50% gain on an account with $500,000 left, so we lost it, now we're going to have a 50% gain, how much do you think that we get in the end? Well, it turns out that we only end up getting $750,000. So controlling the loss is actually more important than trying to capture the gain or looking what that gain number is. It actually takes about 100% of a market gain for you to get back to your balance again. Well, when does that happen? If we look at the periods of time for how long it takes for us to recover from a market drop, especially a drop of 50% or more, the question then becomes, 30% or more, the question becomes, how long does it take for it to get back? So if you have an idea, drop that in the comment box. Let me know how long you think it takes for us to come back from a market drop. So I'll kind of hide the slide, since some of that information is on the slide in there, and put that into the comment box and let me know what you think the amount of the return is, or how long it takes for us to get back to where we were. All right, seeing a couple come through. Okay, so the answer for this is that it in fact takes about 6 years for us to come back in there, or what is 2,100 days on average. And we've seen that. So if you see where the circle is in August of 2000, that's actually where the dot-com bubble was burst. It was coming off the edge of that, and you can see the sort of the decline that happens along the way. It turns out that it wasn't until May through October of 2007 until we reached the same level as where we were before. And then what happened after that, you can see this big drop that comes down, is obviously the recession that happened in 2008, and it takes another essentially 6 years or so for us to come back again. And so that's one of those things where when we're looking at the time for recovery, for us to be able to get back to where we are in there, we're looking at that period of time as being the period that we're trying to control for. When you're in retirement, that's the danger of the control of what you're trying to control for, the danger of having that decline while you're still trying to withdraw money out of various accounts. We don't want to sell out of losing positions, because those losing positions make it impossible for us to get that money back. Remember, we just put up on the screen that if you lost 50% and it was down to 500,000, it would take 100% for that to get back. But then if you removed money from the account, if you removed money from the account because you were withdrawing money to live off of, well, then it's going to take that much longer for that money to come back. So really, when we're thinking about how to navigate retiring in a recession, part of what we're trying to do is control for that period of time, so that in those intervening 6 years, we can let the market come back to where it was and we weren't relying on that money. What does that mean? Well, it often means diversifying the various investments that we have so that what we're working with isn't everything inside of the market. We want to make sure that if you have monies that that are your retirement nest egg, that we haven't essentially done this, right? We haven't gone ahead and put it all on the gambling table as something that we are looking, kind of just keep riding. If you play roulette at all, you know, if you happen to hit a number, you don't let that number ride. You want to take some of the winnings off of the table, and that means making sure that we've got some of this money protected. And that's one of those elements that's going to help you control what you can control. You can control when you take winnings off the table. You can control where those things are to make sure that they will remain at risk as part of what your entire investment strategy is. Again, if this is sort of some of the stuff that you were knowing that you wanted to talk about and you would like the opportunity to explore this more, one of the things you can do is text the word retirement to 609-293-4344. All you do there is you open up your phone, you put that in as the phone number, you text the word retirement to that number, and what will happen is they'll ask you for your name, they'll ask you for an email address, and then you'll get a link to get onto our calendar. So we're going to come back to this one more time before in the end, but if this is something you want to talk about, then we can definitely put you on the calendar for that. One of my favorite quotes, by the way, from Warren Buffett is, "You never know who's swimming naked until the tide goes out." I love that quote. And it really talks about those folks that are representing as though they're doing fantastic with all in their investment strategy, but they really don't have a plan. And it reminds me of what ended up happening as soon as the pandemic occurred. So I had my parents staying with me. Specifically, I had my mom, who unfortunately is suffering from a medical condition that puts her at an immunocompromised level. So she couldn't go out in the world. She usually has an apartment in New York City, but she and my stepdad came and stayed with me. And so I put them to work. Because they were eating me out of house and home. So I said, okay, listen, you're going to have to do something to earn all of this food that you're eating here. So one of the things I did is I had them call all of our clients and put them on my calendar. As soon as the market tanked, I said, listen, I just want to reach out and I want to make sure that everyone is okay. And so we just set up these 15-minute meetings. And what occurred from that were a series of phone calls that all we did was really talk to people about how they were doing. We just kind of chatted in with them and said, hey, listen, what's going on? Are you okay? And for the most part, those folks were just sharing their story of being in lockdown and in quarantine. What was interesting, though, is I had exactly 2 conversations about the market. One of those conversations was just a pure thank you that a client gave us because they were a client that essentially wasn't naked when the tide went out. In fact, all of our clients that take our recommendations were in that position. For a while, I was the crazy guy that was telling people, look, you shouldn't have everything in the market. And realize I was doing this after 10 years worth of positive market returns. I was saying, look, we want to take some of the dry powder off because if some of this ignites, it's going to be a problem. For the most part, people listened to me. And one of the clients that I had the meeting with just said, thank you. Thank you for sort of making sure that I did this because I never had to really worry what was going on with the market. Turns out the other conversation that I had was somebody that said, you know, I didn't listen to what you had to say about keeping some of this powder dry. Is it too late? And so when we think about this idea about kind of figuring out who's making it and who's not, we want to focus on making sure that we, again, are controlling the things that we can control. So let's talk about those things that we can control. As I mentioned to you, I believe that there are essentially 4 things that you can control that become the basis of a plan that we put together. We call it our Make It Last Retirement Checkup. Talk a little bit about that when we get towards the end of this. But we think that there are 4 things that you can control. You control whether or not you have any form of guaranteed income. You can have a control over your investment strategy. You can control your income tax planning and the things that you do for that, and then you can control your estate and your legacy plan. You can't control what the market's going to do. You can't control tax policy. You can't control whether or not you have a particular need or some of those expenses, like if you need a long-term care stay. Can't control whether or not that's going to happen, but you can control your planning around that. So today I want to focus essentially on the tax planning component. So I hope you stick with me on this because this is a very powerful discussion that we get to have in and around tax planning. I'm going to share with you our tax planning philosophy, just the way that we go about this, to see if it kind of matches with the way that you would like to think about your retirement plan. Essentially, we think about taxes in 3 different brackets or buckets. The first one that we talk about is our taxable bucket. And by the way, before we get too deep on this, I want to make a couple of agreements between everybody that's watching now. The first agreement that I want to have is, if there's a tax that we don't necessarily have to pay, let's agree not to pay it. I mean, it's that simple. Let's agree that as a philosophy, we would prefer to not pay a tax that we don't necessarily have to pay. The second agreement is this. If there's a tax that we absolutely have to pay, let's agree to pay it at the lowest rate. If we decide on those 2 things together, if we agree that those are 2 good planning philosophies for the way that we're going to attack tax planning, then the rest of this is going to make sense. If you're somebody, on the other hand, that says that you would love to voluntarily pay for a tax that you don't necessarily have to pay, or that if you're going to have to pay a tax that you're okay paying it with higher rates, you're not going to be a great fit for us or our planning philosophy, because we don't believe in those things. So let's talk a little bit about this taxable account, because this is one of the accounts of different investments that you can make. By the way, this is made up of mutual funds, stocks, bonds, money markets, CDs. You know that you have one of these accounts, by the way, if you're receiving a 1099 at the end of the year. That's a little love letter from the IRS, essentially letting you know that they know about some money that you made, and you better report that on your taxes coming the next year. Well, what should we put in the taxable account? Well, in our world, we think the taxable account should largely be made up of liquid assets, and they should make up their emergency account. Now, using the chat function, I want you to put in what you think is the maximum amount of money that you should have in your taxable account. And it's okay if you're not sure about it. This is not going to hold you to it, but it tends to be that people who are just folks that are talking heads on financial channels, they may not agree on a lot, but they tend to agree on how much they should have on an emergency account. So go ahead and plug that into the chat box, and hopefully those start to come up on the screen off of that. And I'll tell you what we think the maximum amount is. And it tends to be that most people agree that you should have about 6 months in your taxable account, and no more than that. That's the maximum in there. Now, the next account that we think about, and the next tax treatment, are tax-deferred money. Now, tax-deferred money are our 401ks, our IRAs, and our 403bs. And if you're a government employee, you are 457s. Now, these accounts got a special treatment when you contributed to them. You were able to take a tax deduction off of that. How did that work? Well, it turned out that worked because what you contributed into the account, you were able to take off of your income for that year, and you got a deduction. There are essentially 2 deductions that are people's biggest deductions when they live their life. They're the ones that make up the biggest amount of what they're able to deduct. I want you to see if you can guess what those are. Drop them into the comment box along the way off of it. But when we made that tax deduction, it essentially was this offer by the federal government that what we're going to do is essentially take a tax deduction now, because when you go to use this money, your taxes in retirement were going to be lower than where they were. Well, if the 2 biggest deductions that you take, and by the way, those 2 that most people take are your mortgage and the deductions you take for having children, your dependents. If those are the biggest deductions that you get, what don't you have in retirement most of the time? Well, it turns out that you don't have a mortgage most of the time. You've paid it off. It's been 30 years, and many people have gotten their kids out of the house, and so they don't have that as a deduction either. So if we've lost those 2 deductions off of it, do we really have the same sort of tax profile in retirement as we did when we were working? No, it's probably the case that our tax bracket is going to be very similar in retirement to what it was when we were working. And one of the tricks that happens is that those accounts that are tax deferred end up being taxable when they come out as ordinary income. What's that? Well, that's the same thing as your wages. And so when that money comes out, it's as though you earned it like a salary, and you pay taxes at ordinary income rates. Those are the rates that go from 10 to 12 to 22 to 24% and beyond. Well, those tax rates that are being charged off of it are essentially the IRS being your business partner in retirement. What they say is for every dollar, right, because you took this and you put it in the 401k and you invested it and it grew. So you were sort of the money manager off of this account. You might have hired somebody to come in to help it. Maybe you had one fund that grew, but you were essentially the business owner over your 401k and you grew all of that money. Well, the IRS is your tax partner and is now saying, I'd like to split some of those profits with you. And in fact, for every dollar that you made that you'd like to spend, I get to take some of that and I get to take out 22%, 24%. Well, my question for you is your partner able to change the terms when you go to take that money out? In other words, can they change the tax bracket? The answer is yes. In fact, they did. When we had the Trump tax laws, or the Tax Cuts and Jobs Act, when it went into place, in fact, it changed some of those tax rates. So they changed them. Did you know that they also put in the law that that change was only temporary? They're going to change back. And they're going to change back in 2025. At the end of that year, we're going to go back to the old rate. So your partner gets to take a higher percentage of that. So how much do we think you should have in your tax deferred account? Well, we think you should have that amount that is RMD tax free. Well, what is that? Well, the RMD stands for required minimum distribution. That's the amount that you absolutely have to take out from the account based on your age. And that starts now with the newest change called the Secure Act when age 72. What's the tax-free component of it? Well, the tax-free component of it is that everybody starts with some standard deduction. And in fact, the standard deduction and the personal exemption is kind of all combined. And there are people that every year get an amount that they can take out tax-free without paying any taxes. There's a hole in the ground. Now, does everybody have an RMD tax-free? No, not everybody does. And in fact, it turns out that some people are dealt a hand where they're going to be forced to take out some of this money and it's going to have to pay taxes on it. Well, now we get to our second principle. If you have to take money and you have to pay taxes on it, wouldn't it make sense to pay it at the lowest rate? And so here is where I make a statement that gets me sometimes worried that I'm going to get struck by lightning by people around me, which is this. Sometimes it's actually more beneficial for you to proactively pay taxes now because of what you know might be coming in the future, like this change in the tax law. So if you're in a tax bracket of 22% and you know that in 2025 that number is going to jump up to 25%, would it make sense to take more money out at 22 and lock in how much you're going to be paying in taxes and avoid paying it at a higher rate? Well, the answer should be yes. At the same time, you may decide that what you're doing with that is actually lowering the taxes that might get paid by your children. Because when you leave a 401k or IRA behind, that money that ends up getting inherited by them now in the new law has to get taken out over 10 years, and it comes out just like ordinary income to your kids, and they have to pay at their tax rate. And if their tax rate is higher than your tax rate, then they're going to pay more taxes on it, whether it's in the future where the tax rates have gone up, or whether it is when they are inheriting it and they're just working, which means that they got more income than you had in retirement. So again, we want to make sure that we're paying taxes at the lowest possible rate. This last bucket is my favorite bucket. It's the tax-free bucket. And the tax-free bucket, in order for an asset to qualify here, it's got to be tax-free 3 different ways. It has to be tax-free for federal income tax, it has to be tax-free for state income tax, and it has to be tax-free for capital gains. And so let's talk about a kind of investment that people often have in their accounts. I will review statements that people will give me, and I will see from time to time that they own a lot of muni bonds or municipal bonds. And when I ask them, hey, why do you own this? What they tell me is, look, I own this because I want to get the tax-free interest. All right, let's apply the test. Are municipal bonds federal income tax-free? Yeah. Most of the time, they are federal income tax-free. They pass the first test. Are they state income tax-free? Well, that really depends on where that bond was issued. Remember, a municipal bond is essentially a government debt that was issued to say, trust us, we're going to pay this back, but give us some money and we'll pay you some interest over that, and then at the end we'll redeem the bond. Okay. If you're a New Jersey resident and you buy a New Jersey municipal bond, New Jersey is going to treat you okay for that because it's the same government. They don't want to tax the money that you're borrowing them to be spending someplace else, so they're not going to charge you income tax on that interest. But there are 49 other states, and you might decide that you want to diversify your government risk, that you want to invest in municipal bonds in places outside of New Jersey that might be run differently than the way New Jersey's run. And in which case, if you have one of those bonds, then New Jersey says, well, hold on, you decided not to invest with us. You decided you want to invest someplace else. And because of that, what we're going to do is we're going to go ahead and we're going to charge you interest on the money that comes in. So it's not state income tax free. The other thing that people do is that they will go ahead and they will essentially buy a fund of municipal bonds. Well, that interest that's being thrown off by that bond, some of it might be state income tax free, probably going to be federal income tax free. But when we redeem the mutual fund price, when we cash that in, if we've held it for greater than a year and the fund price is higher, then that's going to charge capital gains. And so we don't have that one in that case. So again, those are the 3 tests off of it, but I actually am a little bit more sneaky with the test that I have because I have one more test on top of that, which is that it can't cause taxes on Social Security. Well, what does that mean? Well, let's talk a little bit about what that looks like for whether or not your Social Security is taxed. In order to figure that out, we have to do a calculation called provisional income. That's Schedule A on your Form 1040. What they do is they say, look, we're going to add up everything that you see on the screen. Half of your Social Security, your taxable income, which includes your wages, your interest, your dividends, your tax-deferred income, the money that's coming out of your 401k, and your tax-free interest, your municipal bonds. If the total amount of that money is over $44,000, then half of your Social Security is taxable. Think about that for a second. The money that you put into Social Security was already taxed. Now on the way out, the federal government wants you to pay more taxes on it. So you can see why I am pretty passionate about making sure that the money that you take out, that the money that is in that tax-free account, if we really want to call that tax-free, then it better not cause us to pay more taxes on our Social Security. That gets me back over to my municipal bond discussion because as you can see, tax-free interest is actually included in your provisional income calculation. And depending on where you fall on that, turns out that you can get taxed up to 85% of your Social Security can get added into your taxable income to try to figure out how much tax you owe. So $44,000 for married couples, $34,000 for single individuals. But here again, when we start to think about what we should have or how much we should have in our tax-free account, there's an acronym that I want you to remember. It is AMAP, and that stands for as much as possible. Look, one of the risks that we're trying to help you control for in retirement is tax policy risk. As you're probably aware, Congress passed a stimulus package in response to the COVID-19 pandemic. The size of that package was $3 trillion with a T, trillion dollars. We're going to have to pay for that somehow, and the easiest way to pay for that is to increase our revenues. We're not going to pay for it by reducing our expenses and keeping the revenues the same. We're going to increase our revenues. So that means that our taxes are essentially going to have to go up in order for us to be able to pay for this. So if we collect as much money as possible in our tax-free account and we use that as part of what we are using to live on in retirement, well, then it turns out that we are helping to control for the tax policy in the future. That if it changes, it doesn't bother our retirement because we've set up accounts to do that. Now, in my career, there are two and only two kinds of accounts that qualify for being truly tax-free: federal, state, capital gains, and having no effect on tax, Social Security, how much is taxed. One of them is the greatest gift in the IRS code, which is the Roth IRA and Roth 401k. Oh, by the way, before I get to that, let me talk to you about why I think it's so important for you to save on your Social Security, and it gives me a second to talk about my favorite clients, my in-laws. I have the privilege of having my in-laws in and some of my favorite clients that went in there. And by the way, one of the reasons why they're my favorite clients is, look, my mom and dad had to hire me as a retirement planner and their lawyer. It's almost written into the code. But my mother-in-law and my father-in-law, they have to really like and trust me, everybody, because otherwise I was going to be in trouble. So when they came to me and said, "Can you help with the planning?" I said, I can do that. Mark, good question. But the max tax by Social Security, it's $44,000 for a married couple, $34,000 for a single individual, and essentially the max that can be taxed is up to 85%. So the way that works essentially is that when you end up putting all this stuff together, if you have too much of this other income, you end up getting 85% of your Social Security added in, and that adds up to how much goes into your ordinary bucket off of it. So it's almost like a series of sliding levers. Like the more you get of this, the more of this one comes in. And so you can go from 0% of your Social Security up to 85% of your Social Security. So it turns out, and this is actually going to be related to what I was going to be talking about with my in-laws, Mark, which is that the $60,000 that they were getting as Social Security, it turns out on the way that their income was set up, about $12,750 was going to get added to their Social Security, or that was how much their tax was going to be. And I said to them, there's a way for me to rearrange your assets so you don't have to pay that tax. Remember, I said to you that the first principle was that if there's a tax that we don't have to pay, let's agree not to pay it. And so I said to my in-laws, I have a way for you not to have to pay that tax. We're going to have to rearrange some of your assets to do that, but would you want to be able to do that? And they said, well, what would we do with that money? I said, well, if you invested in it and it made 8% over 20 years, it turns out that would turn into about $430,000. That's real money. It takes about 20 years to do that, but if we left it alone, if we didn't get taxed on that money, and we could invest it in a place that made 8% for 20 years, we could turn that into $430,000. That right there, that's real money. I said, well, if you did that, what would you do with that money? And there's now why you get to figure out why they're my favorite clients. They said, well, if we didn't have to spend that, we don't need it, we could take that $430,000 and we could leave it to you, the kids. I said, that's why you're my favorite clients. So it is important for us to realize that that just making a small amount of savings can have an exponentially important effect, that we can really turn that into something great. And so it's important to be paying attention to the nickels and dimes that might be falling out when we're deciding to pay taxes or not. As I mentioned, there's two investment products that we have found that meet this. The number one that's in the IRS code is Roth 401ks or Roth IRAs. And although we don't use this as often, but when we do, it's got some really powerful planning strategy benefits to it, is some specially designed life insurance. Both of those assets meet all of our tests. They are federal income tax free, state income tax free, and capital gains free. And at the same time, it turns out that they don't have an effect on Social Security. That when we take that money out, it in fact does not cause our Social Security to be increased. Now, what we did over there when we were talking about this this plan over here, let me go put that again. This is tax utopia, okay? That if you had as much or all of your investments in life in tax-free accounts, and then you only had the minimum amount in your tax deferred, and you had 6 months in taxable account, that would be tax utopia. Well, we know, like utopia, very few people live there. We want to live there, but we don't necessarily live there. And so the question then becomes, if you can't live there, because look, here's the thing, I can't change what you did to get here. I can't change that. I can't change what you did to arrive. If you have certain parts where you've got a pension and you've got a large amount in your IRA and you have these things that are set up, I can't change that. We're going to start with that as the beginning part. I can help you change what you do from here on out. I can help you try to figure out what the best way to move forward actually is. And so that's our goal. And the way that we do that is by putting you through our planning process for us to look at all of the elements of the things that you can control to help you set up for the future. As I mentioned before, there are 4 areas that we think are areas that you can control with your planning. You can control how much of your income is fixed and guaranteed, and whether or not you are meeting your minimum for making your necessary expenses along the way. You can control how much you need to make your shortfall and how you're going to do that. And so the income component of it is something that we can assess and try to figure out exactly, do we have the right amount of mix for our income? We can control our investment planning and strategy. We can affect or control the amount of fees that you're paying inside of your account. We can affect or control the diversification of that. We can affect or control the product choice. We can start to move some of this stuff into different buckets. So if we want something inside of the tax-free bucket, we can control a little bit about the way that that works. And then we spent a lot of time here talking about the tax planning, and one of the areas that we didn't talk about was how to control taxes for your beneficiaries. So you may make a decision to start to convert money into a Roth account, because if you do that and you only pay 22%, you've now made a tax-free account for your kids to use in the future. So again, we want to be thinking about more than just you here today, but maybe your goal is to leave something for the next generation, and what we want to do is leave the maximum possible. And then when we talk about estate and legacy planning, we want to control for you what would happen if you had a long-term care stay. If you needed to go into a nursing home, turns out that a long-term care insurance policy may not be the best play for you. One of the things that I learned by spending the majority of my time as a lawyer and focusing on elder law and estate tax planning is that I learned that the legal protections of using trusts and different things to protect assets are actually far more powerful than what a long-term care policy can buy. And so what we want to do is be able to help you navigate what the landmine field might be in the future when it comes down to needing long-term care or controlling for that. And it comes down the line on lots of different areas too, making sure that your estate plan works when you need it, making sure that your beneficiaries pay the minimum amount of taxes, that it's the easiest thing to do along the way, that we're able to just make a transfer when you pass away, or help you control for your spouses and making sure that they have a good quality of life after you're gone. So my goal in kind of getting through today, and I promise you that we'd be done in about 40 minutes, and we're kind of there right now. So I appreciate you sticking with us here along the way. Everyone that's been on has sort of stayed on for the entirety of the webinar. So thank you. It makes me happy that we didn't lose any drop off. But one of the things that we talked about was essentially the opportunity to continue this conversation. And I told you that was the most valuable thing that we could offer you today in terms of information. If you would like to see how this stuff would apply specifically to you, one of the things that you can do is follow up with us, and we can have a conversation with you about what's unique around you and what your goals are. Now, what we're going to do is we're going to be able to essentially put together a plan that's specific to you. Let me see if I can put the plan up up on the screen for you to see. I'm going to drop this on here. Give me a second. Doing this a little bit on the fly. This was what I showed you as being essentially the plan and the way that it works. If you want one of these, what it's going to be able to do is it's going to help you focus in on income, investment, tax, and estate planning. We're going to look at Social Security maximization. We're going to talk about adjusting your risk tolerance. We're going to talk about income tax planning. And each one of these areas that we investigate gets us to look at what's in good order, what kind of works for you, what needs addressing, so what is it that we would think that needs to be fixed, and specifically what our recommendations are in those areas. And that happens for each of the income, investment, tax, estate planning, and then we get a summary of those recommendations as well. And the goal here is for us to be able to look at what's unique around you and then eventually take the next course of action. Again, if you're interested in doing that, what you do is you go ahead and you text the word retirement to 609-293-4344, and we will reach out to you to schedule that next appointment. You go through the whole texting thing. It tells you to get on the calendar, and we'll start the conversation off of that. And the goal for doing that is to get you a plan that will help put you on the right path. We talked about being able to control what we can control. What we want to be able to do is get you resting easy. You're in retirement. Every day should be Saturday. You should be enjoying all of the parts of life that are what you were looking forward to when you were retired. We don't want any part of the news to be overtaking you. When my mom was staying with me, it turned out that the news, when we went in there, was able to do something to, we could, with the news, we were going to be able to kind of put them in and watch it and watch what was good the numbers were. I want you focused on the good things that are happening off of that. Mark had a question, by the way, I'll put it up here, which is when you make a conversion over to a Roth, it turned out that you were able to spread the tax liability over 5 years. And that was something that was the case then, but it turns out that they've rolled back that rule, and they also rolled back a rule that allowed you to recharacterize that. So it turned out that if it turned that account didn't grow very much, that you were able to roll it back and just put it back in your IRA and say, whoops, never mind. So unfortunately, when we do these conversions, we're going to pay the tax up front in that year or in next April when we do that. So we want to kind of navigate where we're going to get that money from and how we're going to pay those taxes along the way. So as I was mentioning, what we want to do is make sure that people are in a position to enjoy retirement, and that's the goal for it. The good news is that we don't charge anything for creation of this plan. We do charge if you do legal planning for us and that kind of stuff, but we don't charge for the creation of the plan. The bad news is we don't do it for everybody. And so our practice is limited in the number of cases that we take over the course of a month, because you can see that the work that we're doing over here, if we're essentially going through all of this for the clients that we're working for and then we're managing this stuff afterwards, we can only really do that for a limited number of clients per month. And so what we're hoping for is that for those people that are really interested in making this next step, that they essentially go ahead and sort of walk through this process in good faith and saying, look, I know that I'm not getting these answers from where I'm at right now. I know that the person that I'm working with, turns out that they're just coming to me with product recommendations, but they've never really put a plan together. I know that I need a plan. The best compliment we get is when we kind of go through this with a client and they say to me, this is what I was looking for. This is what I knew I needed in order to be able to make it through kind of retirement and know that I was comfortable. So we hope that you would take this next step with us. I'm going to stay on the line for a little while longer to see if there's any questions that come up, but I did promise you that we're going to be wrapping up around 40 minutes or so, and I've run over just a few minutes, so pardon me for that. But if you do have any questions, you know that you can follow up with us, and you can reach out. We've been in touch with you with email. Again, if you need the contact information for setting up an appointment, you text the word retirement to 609-293-4344, and then follow the prompts. They're going to ask you for your name, your email address, and then they're going to give you a link to get onto Susan Halem's calendar, and she's going to be the person that helps coordinate the first initial conversations, sets everything up, and then when it comes to the delivery of the plan, then I'll be in there with you to be able to kind of walk through what that delivery looks like and see if we have a meeting of the minds to take the next step. All right, I don't see any additional questions coming up, so what I want to do is thank everybody for coming up. I'm going to end the webinar here. If you do have any questions, feel free to reach out to us, but I did want to thank you for joining us. It turns out we made the right decision. It's still raining outside. The ground's still wet. I'm looking outside off of it, so I'm glad that we didn't invite you over here inside of that. All right? So thank you so much. Oh, Mark, before we go, how much would change if you create trust where you're living in New Jersey and retire for New Hampshire, for example? Great question. One of the things that's great about the trust-based planning is that it's portable. The only document that you need to change if you change residency is your healthcare directive. That's state specific. So for my parents that live between New York and South Carolina, they got 2 pairs of advanced healthcare directives. One that's New York compliant, one that's South Carolina compliant. So that way they, wherever doctor that they go to, it's a form that they recognize and they are expecting to see this. So that's the only thing that we would encourage you to do is look at and change whatever is going on with your healthcare directive, okay? Right, no, I saw it. We're a little delayed, Mark. We're a little delayed off of it. I know that you posted a question. If you want to know more about that, one of the things we can do is we can offer you the opportunity to get my nutshell guide. So I published a guide on estate planning. I've actually published 5 books, but one of them is like a good summary of estate planning. And Mark, I'll go ahead and I'll offer that to you. And anybody else that's in there, if you follow the prompts and schedule an appointment, regardless of what you do with the rest of the planning, we'll send you out a copy of my nutshell guide as our thanks for putting in there, and that will help explain exactly what I answered to you about that. All right, so that will be something that will be in there about the portability, and there are other benefits, specifically if you stay in New Jersey or if you die having been a New Jersey resident. Okay, so I want to thank everybody for coming in and joining us on the webinar. It was great to see everybody stay for the entire time. So that means that hopefully you saw the content valuable and you enjoyed it. And we will talk to you then. All right, talk to you again soon. Bye-bye.